And not that many chairs. Uh, hello? Do you hear me now? Great. Let's take our seats and let's start. We have live streaming going on, so we have to start at 2 minutes ago. Looks like that attracted their attention.
Well done, well done.
Okay, good evening, dear friends. Welcome to Silicon Valley Innovation Center, where we gathered for our last show of 2014. Today on December 19th, we celebrate all the holidays at once. You know, it's coming Christmas and ongoing Hanukkah and New Year that's just around the corner. So we got a great speaker for you tonight, Andrew Romans, who is here to tell us first about his exciting new book, The Entrepreneur's Guide to Venture Capital, which contains all the information you need to learn all the intimate secrets of venture capitalists and what to tell them or what not to tell them. Am I saying it right?
Just keep going with it.
Well, and the important thing about Andrew's book is that it's not just his personal opinion, but he also polled 40 other venture capitalists and provided the information about what they think about the business in his book. So you are getting the essence, the gist of 41 very smart brain in one book. And despite that, the book is written in very concise and easy to understand language. Even I could understand some of them. Some of the things that Andrew was providing as the essence of this fantastic knowledge. I don't know how he does it. Andrew, did you do it by yourself, or you hired a professional ghostwriter to write the book for you?
I actually did this one all by myself, although the next book I'm co-writing with another VC.
Okay.
So there'll be two of us.
Yeah.
But in general, the model is, you know, rather than me tell you a story of what someone else did in a situation, if I know that guy, let him tell the story directly.
Mm-hmm.
So that's really how it happened.
So those 40 VCs that you provide the information about in your book, are those all direct quotes, or you just heard the stories about them?
Oh, no. Most of them wrote it themselves. So like, people wanted to be interviewed. The only people I interviewed, well, I interviewed Tim Draper, but Johnson was the only one I was willing to actually interview. Everyone write it.
Okay.
I'm busy.
Okay. So we would let you start with your presentation, but before that, I just have one question, if you don't mind. Your company is called Rubicon.
Yes.
And you know what this name brings to my mind is the story of a certain Roman general,
Right.
who at one point in history decided that he wants to violate the rule that was set for him and turn what used to be a republic into an empire.
Okay.
So Rubicon, in your understanding, in your company, is it a line that no one else is allowed to cross because you said it, or you crossed it for yourself? That's why you call it Rubicon. Which Rubicon is that?
Yeah,
The one
so-
you crossed or the one you established?
So first of all, I'm sure people all know this, but you know, there's a river in the north of Italy called the Rubicon River,
Yeah.
and in ancient Roman times, to preserve and stop like pharaohs in Egypt from getting coup d'états from the military, they said generals cannot bring their into Italy past the Rubicon River. So that's a big no-no to bring your army with you. And Julius Caesar said, the die's been cast. We're crossing this river. We've passed the point of no return. There's no going back now. And we're planning on sacking Rome. We're thinking big. And so I thought, in founding a venture capital firm, let's appeal to entrepreneurs that are thinking big, that are ready to go past the point of no return, and take down the biggest incumbent and disrupt that industry, that kind of thing. The thing too is that with our model, we raised our fund to begin with all from VC-backed CEOs. So we're backed by a ton of badass CEOs that are much smarter than these VCs, I think. And so there's a bit of an army, supporting the fund, from deal flow to vetting the deals to helping the companies after we put money in.
So that's your legion. That's the legion you're bringing to sack the Rome.
A little bit, yeah. I think of it that way. And I think of our CEOs as part of it too. They sort. The best form of finding a new deal is from one of your own CEOs.
So at some certain point in time, your company will be renamed Roman's Empire.
I don't think so. Definitely not. Definitely not.
Well, as long as you don't meet any Brutus along the way, I wish you luck.
Yeah, I've heard some bad. I've heard some bad. Like, oh, Caesar was a bad guy.
No,
stuff
no.
like that. But you know what else is funny too? 49 was 49 BC when this happened. And San Francisco went from a fishing village to like a big city, and 49. So this name was definitely the right name for us.
Yeah. Okay. Hey,
Great.
49ers. Okay. Without further ado, the floor is yours, so you can go to the safety of your presentation.
Yeah. Okay, great. So I'm going to go through these. Oh, Andre.
We need to turn your mic on.
Oh, jeez.
It's turned on. Actually, it is on.
It was on.
Can you hear me? I get a little closer to here. Okay, I get very annoyed if I'm sitting in the audience and the guy is just mousy and into the mic. So raise your hand if I'm not loud enough. So I'll cover this topic a little bit. I think this is an important topic, but it may not be that relevant for everyone here. So maybe just quickly, who here is associated with a corporate that's either already making venture capital investments or thinking about it? Okay, so it's a pretty small subset. So I think it's useful for everybody to get some sense of, some of my thinking and experience on this topic. But what we're talking about is, and then we'll just completely open it up and get into whatever topics that we want to cover on anything associated with starting a company, raising angel money, building value, raising VC funding, exiting, anything you want to talk about. But I'll go through this stuff first, okay? So corporate venture capital, I call it CVC, and that's, pretty common. I think that, okay, and lawyers never want me to go to prison. I don't want to go to prison either. I'm not, soliciting anyone to invest in my fund. That's the basic message, and I'm sure this font is on the back row, right? So, quick thing on myself, just, what's my background? So I'm an entrepreneur at heart. I had like 5 businesses before I was 18. Fortunately, those were the good ones because they didn't need investors. I had businesses that actually made money. My first, venture-backed business was actually similar. It was making money. I think it's a great point of advice of don't just come up with an idea, conductor factory that's going to require a ton of money. Come up with something that makes money. On the topic of corporate venture capital, I have mixed experiences where I actually raised from Lucent Technologies and Lucent Ventures a lot of money. So I had this experience of getting married to a large corporate company when they themselves were in a turbulent time. So went from an entrepreneur who's raised a lot of venture capital funding for myself, spent about a decade advising VCs startups on raising more money. So I was paid like the blood-sucking, dirty investment banker for the venture deals. But, a lot of even the book comes from that. And then I founded something called the Founders Club, which is kind of exotic and complicated. There was 40 VCs on the board, on the advisory board for that. And I was seeing a ton of financings. And it was actually in those days that people were saying, please write a book, because these stories would be valuable to other people. And then I started to say, let's just collect the stories and write a book. And I guess, back to it. And then I founded my own venture capital fund. So I basically thought, we've got a great business network to help guys. Let's go with a bit more less exotic model of raise money from other people and invest that into startups, which is, more than I could do with my own capital, and this is always, Andre always has an international crowd. I lived in Europe for 15 years. I speak in languages. So I'm not, I'm not just God bless Texas kind of guy. I believe in the whole world. And I think that, it's an international period in history anyway, especially if you're on the internet. So this is kind of fun. So this is the book. And apparently, like today, or big publishers are never clear. The book is just been translated and it's coming out in Russian language. It's also coming out. I can't even get a copy of the cover of it. It's already been printed in Chinese. So it's been printed in simple form Chinese and Russian. That's happening right now, and we're working on a Japanese translation too. For me, I kind of like it because it's easier to communicate with people that might want to invest in the venture capital asset class. And that's one of the great things about the book for me, as well as sourcing deal flow and getting to know people that get to know me by reading the book. So enough about the book. So corporate VCs, there's a big opportunity. If you're the CEO of British Telecom or some huge, massive company, you know, if we just did a little, we could give a startup a bit of our business and overnight turn it into a massive company. Like kind of like if you were Toyota, you could invest in a company that makes spark plugs and give it a purchase order for 200 million bucks, and then turn around to like the other investment bank in your Kretsu and IPO it based on that PO, on that purchase order. I mean, that's just like organized. It's like Tony Soprano but legal. So the idea of corporate venture capital, it's very attractive. Also, when the economy gets bad, they pay McKinsey to say, you got to get out of all those other businesses and get back to your knitting. What's our core business? And then when the economy gets good and they see young people getting rich on IPOs, they're like, I want some of that too, right? So they kind of come back and forth. And definitely where we are in the economic cycle is corporates are thinking, how can I get me some of that? And I want to mint a company overnight. And there's a lot of things that they're interested in. But basically, they want to use their resources and capabilities, their distribution channels, to grow revenues of a startup while owning some of it. They want to get into different product and service offerings. So you're the monopoly, your former monopoly in Sweden for telecom. Maybe you should get into a bit of travel e-commerce. They're getting into different things. There's also the R&D thing. It's nowhere is it more clear than in biotech, where the patent cliffs came. They don't have the revenue to maintain all this R&D. They're going to move some of it out. I remember I had raised money from Lucent, and I saw an interview with John Chambers, here, CEO of Cisco, and they said, how do you plan, Mr. Chambers, to compete with Bell Laboratories? I mean, AT&T's got Bell Labs. That's what, like 90,000 engineers that know a ton about telecom, and you're basically a startup with a couple thousand people. And Chambers very confidently said, we've got the Silicon Valley. We've invested in VC funds. We've got optics into all the innovation that's actually happening in telecom, not just what's happening at the Water Jug in New Jersey, where Bell Labs is. And we might invest out of our corporate VC, maybe take 10% of a company, sit back, take a minority position, and if it really takes off, I'm the first to know. I'll either buy that company or I'll do something else. So I thought that was interesting. At a young age for me, I kind of got a little jazzed by Chambers' ability to like leverage the whole universe as opposed to trying to bottoms up hire and staff with his HR department the whole thing. So there's definitely a very important place for CVCs and corporate venture capital to play a role, and for all of us entrepreneurs in the room, how to get that right. Okay, so that's like the upside. That's like the shiny object that as entrepreneurs and CVCs and investors in all these companies we should be going for. But having lived through 2 decades of reality, there's some major problems. Like the number of people I've met that worked at Intel Capital compared to the number of people I know that work at Intel Capital is like 90% are ex Intel Cap. And I think one of the major reasons is that the compensation program that they get. So there are, of the CVCs that are here, the corporate VCs that are here, one bit of advice I would give is consider actually biting the bullet and get into the 2 and 20 structure, where the people that work at your CVC get paid the way I get paid, rather than just be on a salary. So the typical thing is they start off investing off the balance sheet of the corporate. There's no specific dollar value of how big is the fund, how much goes into early or later or follow-ons. They're just saying, hey, man, we're huge. We can invest off the balance sheet whenever we damn well want money. And this is a drop in the ocean for us. Well, this is a problem. Let me explain what 2 and 20 is. I'm sure you all know, but just in case. Let's say you and I raise a fund, 50-50 partners, and it's a $100 million fund. We get a 2 and 20 compensation. What it means is that every single year we draw down 2% of the fund to pay our salaries and expenses, our office space, our team, buying dinner and drinks for CEOs. So for a $100 million fund, we'd have $2 million a year as our budget for our salaries and our expenses for running the fund. And so that might sound like a lot. After 5 years, that's 2, 4, 6, 8, 10% of the $100 million gone to pay me and you. and then maybe unlike most VCs, we invest in our business and use some of that money to not just build a bigger kitchen, but to hire people. And then after 10 years of the fund, it's a 10-year. It's actually 20% of the paid-in capital has been paid to maintain high-quality expenses. And if people want to go lower on that, you're typically going to see a degradation in quality, and it's very, very noticeable. But that's actually not why we're really in it. When we invest in the startups and then we divest by selling the stock that we had purchased, be from IPO, M&A, or a secondary sale, we might sell something before the definitive liquidity event for the company. That's a secondary. So when we get our money out, we pay back the fund until the investors get their full 80 million plus the 20 million we spent on ourselves. They get the 100 million back. And then once they're paid off and made whole, it's an 80. Now you and I carve out 20% of all the profit. So basically, to be a VC, raise $100 million, invest it in a bunch of companies, hope to get lucky and sell something, pay back the investor, and keep 20% of the profit. That's 2 and 20. Work at a corporate VC, what often happens is your financial compensation is tied to the performance of the corporate, not even like tied to the performance of what you're doing. If I, as a blood-sucking venture capitalist, invest in some startup, the CEO starts to feel it that I'm rooting for the home team. I want to see this startup become a billion-dollar company. They can definitely feel it. Whereas the corporate VC might be like, I'm not even getting paid because Motorola had a bad year here at Motorola Ventures. So this is a big issue, and that's easy to fix issue, and it's one of the reasons why CVCs fail to become a dynasty and maintain a team that stays together for 30 years, figuring out subliminal language of how to communicate. So I would encourage CVCs to cut to the chase and start paying their own team VCs with a 2 and 20 structure. Now, it's very tough to get that done when there's someone in the organization who is like overseeing it, making less money than the person who somehow does it. So there's a lot of politics in a French law firm, and there's maybe even more in these big corporates. So there's a lot of kind of blockades for that to happen. Limited deal flow. I mean, I've seen this too. I mean, even myself as an entrepreneur, I remember Nokia Ventures before the mobile internet really took off. You wouldn't feel like I should send my business plan to Nokia unless we're more mobile focused. So people weren't really sending their deals to Nokia, even though Nokia said, they could say, oh, but we do everything. We do e-commerce and software and enterprise, B2B, B2C. But so this becomes an issue. And like SAP Ventures, what do they get? Motorola Ventures, what do they get? Even Intel Cap, what do they get? So there's a little bit of a lack of deal flow. And there's other reasons that will inhibit them from getting deal flow. At the end of the day, deal flow is the lifeblood of a VC fund. Think of yourself as the investor in the VC fund. If one VC fund has 10,000 deals a year, and they're only making 5 or 10 investments a year, out of that funnel out of the 10,000, they invested in their top ones, and they're investigating along the way the best ones. And some other VC, a CVC, only has like 1,000 deals to choose from, and he's trying to invest in the same pace with the other guy. You'll with the guy who's got better deal flow. It's a little bit of more deal flow, but it's also higher quality deal flow. Especially right now in history, it's easy to get a ton of deal flow. That doesn't necessarily mean the good deal flow. CEO fear of loss of neutrality. This is almost a young man, young woman's disease, and they should get over it, but I think it's timeless. I once turned down of Telefonica, British Telecom, and AT&T to buy a third of my company. If I had done that, I would have walked out with like almost billions of revenue guaranteed, and who cares about the rest of them? But being young and dumb, I turned it down and said, oh, we're going to lose level 3. We're going to lose the competitors if we side with those big, naughty incumbents. And so I turned it down. That was the stupidest thing I've ever done. But I see it with my own portfolio CEOs. We have an opportunity for some big Japanese corporate or something to invest, and they're worried about alienating the other ones. It's basically a bird in the hand, situation. I have graphic analogies and metaphors I use to try to convince them that it's a good idea say, hey, if two people are ready to rock and roll with you right now, don't say no to them because you want to rock and roll with everybody else in the bar. Just take what you got coming there. But this is a problem. And, the guys from SAP Ventures would beat their chest about saying, oh, we've sold more of our portfolio companies to Oracle than we have to, SAP. They got a chip on their shoulder. It's something, to understand, and it's a challenge. We'll get to it later of even changing your name. SAP Ventures changed their name to Sapphire Ventures. Slow to act. So, the corporate VCs are notoriously slow to actually make a move and issue a term sheet and then take term sheet to money wired in the bank. And CEOs in places like Israel and Silicon Valley are particularly highly networked, and they speak to each other a lot, and they gets around. So your reputation as a VC will get around. If you become a bad operator, people are going to find out about it. Not that they're bad operators, but it's not so easy for a typical CVC to make. So if I were a CVC and I and my partners have made the emotional decision, we've crossed the point of deciding we want to put money into this company, we want to be in this round right now. Sometimes, like Motorola Ventures, I can pick on them because they're gone. Moto Ventures needed to get at least one head of a business division. I don't know exactly what that means, but not everybody is one. And they had to get a head of a business division to actually fill out a memo that says, we're not going to try and build it ourselves. We'd rather buy it, or we'd be ready to do business with this company, and I mean now, not just next year, but like now. So in order to get the money out of Moto Ventures, a CVC, you had to make the sale to the VC to want to invest in your company, and you had to get like an enterprise sale with them. And for a lot of us here know what a pain in the butt that is, just doing the enterprise sale. Forget these VCs who are looking at, a needle out of a haystack of 10,000 deals into one. So it means that what ends up happening is that the CVC fails to actually get the money wired off to the company because the round closed, because someone like me moves faster. All I actually need is Josh Siegel to agree with me. We both have to fall in love, and once we both agree, we can wire money from our mobile app, from SVB, and bang, and wire money. The CVC just can't keep up with it. So if it's a really tough one, it's even my job to get the corporate VC into the deal that I've invested in, and we understand what we're dealing with. So speed is an issue. So what will actually happen is that the CVC fails to get into the round he wanted to get into, and ends up in the next round when the valuation has been de-risked and is higher. So, if you're not careful, so if Sony knows what it's doing, they're going to get in this deal now at a 10 million pre-money valuation, not the next round, which might be a 70 million pre. And when you're trying to show someone your financial performance, having invested in at the 10 million pre versus 7 million pre, it's going to have a material impact on your IRR when you want to make a break from just having one shareholder. So speed is part of business, and technology moves fast. Accounting and antitrust. I remember seeing when I was an advisor, these CVCs would present themselves like, hey, unlike those other vulture capitalists that want to buy up your whole business, we actually can't ever get to 20% because then I'd have to consolidate your crappy revenues and losses with ours, and we're big publicly traded, bad big old company. So the last thing we want is for, general accounting principles, to consolidate your financials. So actually, we're good guys. We never want to own more than 20%. That's not always a good thing when you're trying to, actually take a company all the way to the finish line. Someone has this problem that they cannot invest because of accounting things, So and a lot of them are so big. Intel's famous for it. The Department of Justice once broke up Microsoft, the monopoly of the operating system and the apps, and it never happened. It just made that was the pin that burst the bubble, in my opinion. But, there are antitrust issues for some humongous corporates. And so just when everything's signed, that business head is signed, and you're waiting for money to get wired, that money's not exactly coming out of venture services as easily as the other one. So people kind of hear about that. So they tend to come in a little bit in the later rounds. Last thing is, and I don't know if it's true, and things are always changing, but people say that the CVC can't price around, and therefore they can't lead around. So they're basically, what you often see is like Sequoia in the Series A, Series B, bring in a bunch of other VCs. Maybe you got like VMware put in some money and Cisco put in some money, and now the CVCs are pouring in. Series C, you got like Verizon Wireless and Sprint is in, and now it's time to get the corporates in. That's often what it really looks like. It's not going back to the first slide of the CEO having an excited, I want to get into venture capital. It's not quite unlocking all those strategies that they might have originally been thinking of. So this is kind of what the past 20 years looks like. Hopefully this will change, and we'll see CVCs, deliver like a billionaire more than I can, right? But this is sort of the physics and gravity that have been slowing them down, a little bit of that. And of course, this hurts your deal flow. If everybody knows that you can't lead, like, well, why should I bother? I'm trying to balance customers, my team, my product, raising money from these painful VCs that keep asking questions and never wire money. And forget that CVC. Those guys, they can't even lead and they can't move fast. So it hurts their deal flow. So, what are the choices of the corporate? Okay, like what are the choices for them to get into this, particularly if they agree with anything I've said, and I'm sure they disagree with more than 50% of what I said. That's fine. I would say one is start their own CVC. So you're a big company in China. You think you're going to move to San Francisco and become as effective as Sequoia? Good luck with that. But I'm not going to stop you. Go ahead and try. So one thing is to start your own, CVC. Maybe change the name and don't really call it, Huawei Ventures, or give it a different name. But that's one option. Invest directly in startups with your own management team. Pay them a salary or pay them 2 and 20. Either way, that's option number one. Option number two is fund of funds. Get your feet into the asset class. Go invest in AdVec, and they will be writing $25 million checks into dynastic VCs that are in decade number 2 and 3. That's one way to do it. If you do that, there'll be a middle layer of fees, and it might not unlock those synergies that your CEO is getting excited about. If Sony is in a fund of funds, will there be too much insulation between the startup, the VC, the fund of funds, and actually Sony? Maybe. I don't know. That's a concern. Do I have number one, and number two? Okay, so no one was going to tell me. I was just going to be up here with the webcast people. Okay, so obviously this is meant to be number two, and this is number three. Number three would be invest in one or more VC funds and negotiate co-investment rights, and then get your smart team that understands how to navigate the labyrinth of your big corporate, and then be directly with VCs, breakfast, lunch, dinners, networking events, meet the CEOs, decide which ones are good. You've got like a bit of filtering that every deal you get into is theoretically qualified by these professional guys, and now you're co-investing. My fund is set up that every one of our LPs can co-invest in every single one of our deals. It moves too fast that there's no sidecar fund. So our model at Rubicon is the fund moves quickly and makes an investment, and then we open it up to a body of angels, corporates, and institutional investors and say, you have no control over where I put the fund money. I do that with just 2 other guys, and really only 2 of us have to make the decision. But you can double down into any deal that you think you can add value to. And that's to the angels and to the VCs. Interesting, the angels rarely can invest in a Series A, B, C, or later. They invest up into the VCs, and they're doing their $50,000 check or $500,000 check. Once the company's doing like a $30 million round, nobody wants the CEO going to Starbucks meeting some guy about $50K or $250K. Like kind of minimum investments maybe $5 million. We actually get angel money into Series A, B, C, D, and later because we aggregate it into one sidecar fund. We might aggregate a corporate, and the CEO gets 1 check from the fund, Rubicon, and 1 check from the sidecar fund, Rubicon. And then we try to synergy. So like we were talking about, good to be on the board of Partender, right? So we try to populate our startups with guys that actually know what they're doing, not these generalist VCs that are all over the place chasing too many things. But I think if I were to mess up the numbering, I would call this number 2, this number 1, and this number 1, because I think they kind of coexist nicely. I think that you can invest in a couple of VC funds and really be active with them. Get the fund of funds probably out of the way. That's only going to hit your return and financials anyway. And then have the have your own team who understands your business better than me, who just maybe raise money from you, and be able to get into the deals that you want with co-investing or through a sidecar fund, better. A lot of VCs are happy to have their LPs invest in either an opportunity fund that they aggregate or even go direct. And so are we. We're set up to not pick favorites on letting our investors invest in it. All right, so how does this movie end? And this is, a lot of people will debate this, but from what I've experienced personally, this is the typical flow of the CVC journey, and I would hope that somebody from watching the movie could maybe jump right to the stage that they want to be. One, they screw up compensation, and if you have the right guys that grew up in your company that managed to become an effective VC, even though he might not be qualified for it, starts to do well, he's going to be hanging out with me and say, dude, you got 20% of the profit and you're getting, 2% of a $100 million fund, and you raise a new fund every 2 years and the new fund is $300 million. What am I doing with a crappy salary working at Motorola? So get the compensation right and just have the CVC put the money into Sony Ventures, and then you run it as a 2 and 20, and you will attract hot managers that want to work there, and there'll be talent. Success follows talent. Second thing is the managers realize that having one investor is a bit risky. If you've got one LP in your now 2 and 20 fund, what if they discontinue the program? And McKinsey said, get back to your knitting, get to the core business. You're in crisis mode. So to be trying to have a new fund every 3 years with one investor that's a corporate, I think it's a little risky. And I've seen the movie. SAP Ventures, great example. They diversified. They went to 2 and 20, then they diversified their LP. So now they're pushing down that one corporate to only be like 30% of the fund. And now there's all kinds of identity issues. And the CEO of SAP is saying, do I even own enough of these startups to give a damn to give them that spark plugs order that IPOs them? So there's a little bit of confusion in there. But if you're running the CVC, who cares what that CEO thinks anyway? Just go and diversify and be the hottest VC you can be. Then they realize, we got to change our name. Nokia Ventures changed its name to Blue Run Ventures. Novell, Blake Modierski started off Novell as a fund of funds actually, and then said, why am I doing that? I'm on the board of all those VCs. I could do it myself. Let's go Novell Ventures. They changed it to Utah Ventures. Then they realized we're not even getting, someone said, let's make it UT Ventures. That's the acronym for Utah. That didn't fool anybody. And then they finally said, all right, Pelion. That's cool. Top of a mountain, antiquity. So it's Pelion Ventures. So this is like, this movie repeated it many, many times. They eventually dropped the name. Okay. And then they say, like, who are we fooling? We're in SAP. They've changed their name to Sapphire Ventures, but they're in the SAP building. I personally get impressed. If I'm a little CEO and I drive up in my little, Toyota, and I see, I'm meeting Sapphire inside of SAP Ventures, and he goes, oh, by the way, let me introduce you to the head of this and that. I think it's okay. But they might consider going to San Francisco, where a lot of VCs are going anyway. So that's a little bit of like, where I see the movie going, and it'll repeat itself probably. But maybe somebody would agree with some of my points and shoot a little faster, into that. So that's the boring bit. Why don't we, Arthur, do we want to do any questions, or should we open it up to the floor? I'm happy to discuss this topic or anything at all, from starting a company to selling it to raising money to whatever you feel like talking about.
Andrew, if you don't mind, I'll just set the tone for the questions. And my question is, most of the system should be on, but thank you. I'll see what's going on. Oh, it's on. It's just me. I'm just too quiet. Here's the thing. Most of the things we're talking about applies predominantly to Silicon Valley, right? Or is it the same around the world? Do you see the same patterns in
It's around the world.
In your international travel? Germany, France,
Absolutely.
Israel?
Yeah. So, SAP actually is a German company.
Mm-hmm.
And Jörg Silvert was the founding guy. He's moved out, like many CVCs. Although he did ride it into 2 and 20, and then he found something better to do. Like Novartis, Anja Koenig, she set up Novartis venture fund in the biotech space. Day one, 700 million euros, one LP. That's the right way to do it. You probably do want to call yourself Novartis. They're like Microsoft in their industry. So short answer, I think that this is definitely not limited to Silicon Valley.
But are there any differences, any cultural particularities that you noticed?
With on the CVC realm or just
Yeah.
in general?
Yes, on the CVC.
On the CVC level, I think I made a when we're fantasizing about having $100 million fund there, that most VCs do not invest a lot of their 2% management fee into their own business, right? It's driven by greed and stupidity, I suppose. The Google Ventures is by far the coolest CVC I've ever bumped into. The place is a total candy store. We co-invest with them, frequently. We often recognize it makes sense for them, but not for us, so we don't just follow them in blindly into the pit. But I think that it's unusual as advanced and innovative as Google Ventures. So if you want to call them Mountain View and they're hyper-local, like Google Asia, Google Europe, those guys never on in Mountain View. They can't get anything done unless they're like sitting on Larry's lap or something. But that's an example of really doing it right. And they even have amazing Chinese wall between Corp Dev, their M&A group, and the proper company, and then Google Ventures. And I believe them.
And to follow on the recent white paper that you about future of VC, would you maybe summarize it? What should we expect in the year 2015? What horizons are changing in venture capital?
Yeah, sure. Well, one thing, and I'll tie in a bit more of an answer to your previous question, is that there's just nowhere else I've been in the world that has so many big balance sheet companies that can buy an internet or software company. Biotech's a little different. Europe really holds on, although we're doing well here and in Boston. Not into biotech. I've dipped my toe with the Founders Club, but the fact that there's Facebook, Yahoo, Google, Twitter, Salesforce, there's so many companies right around. It's a 20-minute drive with no traffic from here, that there's nothing like it. And so a CVC here can actually start to integrate itself with all of these other big companies and then the critical mass of VCs. So the ecosystem here is just so evolved that it's hard for anything else, to get close to that. On the topic of the future, I don't want to just regurgitate stuff that I wrote in that little blog post, which, by the way, I wrote that to be the last chapter of the Russian edition of the book, and then I decided, with McGraw-Hill not looking, I'm just going to give it away. They don't want me to give away anything. But I'd say the future is that the investor must add value. So if you're dealing with the angel level and you're going to get diluted as an entrepreneur, rather than just take money from some passive rich person who's just hoping to make a financial return, or even an anonymous crowdfunding person, to try and get someone that's going to do something for you. They're going to either help you raise more capital, help you get customers, helping you with your product, some of the core fundamental building blocks of your business. And I think that when you're dealing with entrepreneurs that have already had success, or through osmosis of being involved tech corridor like here or Boulder or anywhere, I don't like Silicon Valley snobs. So although I just made a case for it's all here, I'm all about it being everywhere. And so it might be that you're based in Boulder and you get an investor who's based in the Valley. So we were in the first round of TAC based in Cleveland, Ohio. And we then introduced them to everybody else who invested in that company. So now they've got a syndicate of New York and the Valley, super strong. And the CEO and his wife have moved here. And we're keeping development in Ohio like it's Herzliya, Israel. That's our nearshore development, secret weapon. So a VC needs to demonstrate how they're going to add value before they get in. And to tie it to the CVCs should have an easy time making that case. To be able to actually execute and deliver on the promise might be, more difficult, but they should be able to, deliver. This is what I will do for you. Invest. Now do what you said you were going to do.
Okay. Well, I wouldn't want to monopolize you, and I would encourage our guests to ask their questions. We have some microphones to go around here. Okay, start with you. And the next question was coming out of there somewhere, and if you could pass the microphone, you could get ready while the first question is going on.
I raised my hand.
Should be.
Hello, hello. I raised my hand basically representing CVC, but I'm actually a venture fund that supports CVCs because CVCs don't know how to do it. So I really appreciate you saying what you said today. How do you look at venture capital and CVCs with incubators? We're sitting inside an incubator tonight, and many incubators show up with their own fund source, and many others show up looking for players. How do you see the incubator space changing the way you look for deal flow?
Okay, so let me make sure. I think there's more than one question in there. So incubators and CVCs and incubators and corporates are a nice fit, in my opinion. So like even in like Eindhoven in early February, where Philips and other large corporates are saying, this place looks like Bayonne, New Jersey. How are we going to get an entrepreneur to want to come here or stay here? And making a accelerator, perhaps looking a little bit at Pacific Coast Highway 1, PCH 1 here in SF, is a good idea. So I think it's a natural fit. Vodafone invested in Startup Bootcamp in Amsterdam. That's a good fit. Citigroup invested in Level 39 in London. So I think that the accelerators are a good fit for the corporate that wants to buy access into innovation as opposed to what they're going to see at their water jug. That makes sense. Other questions so I can be specific. Okay. Oh, yeah. Okay. You're going to force me to answer the question with this model. Okay. So when does it make sense for a financial venture capitalist like Rubicon Venture Capital to tag team, pull in a CVC? And also, how does our deal flow pair up, I think, with a CVC? Is that right? Okay. So example is we invested in a hardware/software-based company. There are two, actually, rather recently, and they both have manufacturing components to them. Okay, with one of them, we brought in a originally Taiwanese VC that I'm good friends with, because I can get screwed over in Shenzhen, but these guys from Taiwan are less likely to get screwed over in Shenzhen. So, plus I really like them, and so I was happy to give them a freebie, and then hopefully they'll bring me a freebie. So it's a lot of kind of karma points in this industry. Rather than I see a good deal, I want it all for me. So I position that. Then I'll say it like this: Flextronics and Foxconn. These are basically, we brought it down to these two, and they're both trying hard to get into venture deals. And we basically made the intros. We're not the boss. We just invest and support, right? So I said, dude, it's a matter of chemistry, it's a matter of economics, it's a matter of all kinds of things. Business better than me. Here's what I think about Foxconn. Here's what I think about Lab 9, Flextronics. You do what you want to do. And we even kept all the VCs out from investing at this current valuation, and we let one of those two invest in that company. And I would even say like everybody wants in on that deal. And we thought we're filling in our missing gaps. We're getting our armor ready for war by getting that done. There was issues of you want to manufacture something. Manufacturers say that they want to do business with like Apple. They want to be making iPads. They don't want to be making a run of 100 devices or 200 units. They want 10,000 as the minimum run. And that's not exactly how our startups are scaling in the early stage. So it was good for us to get a fit with them. Another one is Zohar Levkovitz, who's one of our investors. He's the founder of Amobi, And he had Sequoia in the Series A, he had Globespan in the Series B, he had Cisco in there, and then he brought in Verizon. And I was thinking of him when I get that example. He brought in Verizon and Sprint, and now they wanted distribution onto the mobile. It was a mobile phone. It was like double click on mobiles. So, advertising on the mobile internet, right? And so by getting these strategics in with a ton of, handsets and ability to push on, it gave us countries specifically. IKEA is another one. IKEA can help us launch one of our startups in New Zealand and then enter the bazillion stores they've got in China alone. You could talk to Sequoia all day long about what they've done in China. They've been back from China with hangovers or something, but IKEA's got footprint,
Well, I wonder what you think of the recent trend that the company prefer to stay private much, much longer than you used to be. And as an early investor, that means your exit is much longer.
There's a lot. Okay. Actually, so the last chapter of my book is called The Ladder to Liquidity. At one point, I was worth a ton of money on paper, and I was never able to sell any of that stock in waiting for an IPO and a very long. And I emotionally thought it was not right or just that some investment banker from Morgan Stanley can show up to my business and get paid before me on stuff when I was the first person working at that company. Just didn't feel right to me. The other thing is I'm watching these VCs, these blood-sucking VCs are getting their big management fees, and they got preferred shares ahead of me as the founder with my common shares. And they're making tons of money, and then I've got all my eggs in one basket. The VC's diversified across all his portfolio. He might even be diversified across different vintages, raising a new fund every 3 years. So I've got it all on the line. And some people would say we like our CEOs to have their feet to the fire. So Sarbanes-Oxley happened. The average time delay between Series A and in 2002 for startups that had at least one U.S. domiciled venture capital firm backing them, so that would include Israelis with Benchmark investing in them, was 2 years. It's hard to even believe that. 2002, didn't we just have a recession? We all died in the dot-com dead? And it was 2 years. But if you remember, it was like, MySpace. They launched MySpace. Their $550 million sold to News Corp. It was Skype, it was YouTube, and all that. So it was a 2-year time delay. To slow down, and the chart just gets more years. Then we have Credit Crunch, August 2007, Sequoia Slide, September 2008. Rest in peace, good times. Volcanoes, Lehman Brothers, and all that. Iceland is gone. So then all of a sudden, nobody even wanted to sell at the bad valuation, and VCs are unplugging everybody, and it was a disaster. So the time delay from Series A to exit by 2008, not including the fourth quarter numbers, and I ran these numbers, was 7 years. Okay, so it went from 2 to 7. How many startups can I do in my own career when it's a 7-year time delay between startup to a successful exit? And then it costs over $6 million just to technically pay Ernst & Young and everybody else to do an IPO with Sarbanes-Oxley. So the mantra became for everybody, stay private longer, stay private longer. And then we evolved into the secondary market. So when I could not sell, the reason I couldn't sell any shares in Global Tel Exchange before the IPO is because I couldn't. Whereas now, if you have shares in Kabam or Dropbox or Palantir or any one of these companies, you can sell almost at any time. And if your VCs are being assholes about it, just get somebody ready to buy and submit an offer to the board of directors and say, exercise your right of first refusal within 45 days, as the shareholder agreement says, or else let this transaction, or you just buy it at the same price, or you let me sell, right? And then guys like Fidelity, they realize that the pop they get in price from IPO day to a few days later is not as big as it used to be. So they're better off getting into these companies while they're still private, have the crystal ball of time become inside. If it does happen, then they're ready to move faster, take a bigger bite. So we've seen a new world, and this is a bit of the future of venture capital too. In the new world, founders, employees, investors can sell stock on the secondary market. When I described how we exit earlier in the presentation, I said it's IPO, M&A, or secondary, or the definitive liquidity event of the company. So what that means is that I could, as an angel investor, invest in a startup with an advisory round or something at like a $1 million or $5 million pre-money valuation, I could help that company and bring it up. Now I'm past that. Let's say it's somebody else's angel. Then I'm investing out of my fund into it at an early valuation. And now it's getting to like a $250 million valuation, and I invested at a $5 million valuation. That's not a bad return. If I've got $1 million into a company, it's hitting $1 billion pre-money valuation on some kind of Uber-esque financing round, I might as well bring my investment to a zero-cost investment. And if the founders are Israelis and they want to do shopping in the, in the Tel Aviv airport and start spending some money, I want to get my fund into carry. I want a $1 billion exit here. I appreciate your last 3 startups failed. You're on wife number 6 here. Let's just have you take some chips off the table, yeah? So we got like $1 billion valuation or a $250 million valuation. You own 20. Hey, Zohar Levkovitz. Let's go back to that guy who is Israeli. So Google buys AdMob for $850 million, I think, and that week Yahoo offers him $300 million cash to buy them out. Sequoia says, Zohar, don't take it. Don't take it. And he's like, well, I own the 26% of the company. I might just take it. And they said, no. Why don't we'll buy $5 million of your common at like a pretty lofty valuation, and then you promise to ride us into a much bigger exit. So he took $5 million, bought a house in Atherton, keep the home front happy. Now we can invest in my fund. We take little bits. And like 3 years later, they sell to Singtel for like 303, or like it was either 303, 36, or 300. Let's call it 309 million. So 3 years later, like a drop. So they maybe should have just taken that deal, before. But Zohar, and by the way, the Sequoia who bought the secondary, when they bought that 5 million of common shares underneath the waterfall of all the preferred guys, they sold that for 20 million. So he left 15 million on the table, and he'll tell you today that that was the smartest thing he ever did as an entrepreneur and for his family, to leave 15 million on the table, and he went from owning like 27% to owning 26%. He took a ton of that 309 or whatever it was out. So it makes sense. If you think of a company that is raising funding, they could be raising funding going from like a 3 million to a 30 million to a 3 valuation. And as they're going up, they might say, hey, we're going to sell $1 million each for the founders to take some money off the table and not take any retained earnings and pay a dividend. We don't want to slow down the growth. In fact, it's expensive to live in the Silicon Valley or San Francisco or New York or London. It's like not getting any cheaper is what I feel like here, right? And so even your engineers need some liquidity. And you don't necessarily want to give them a salary that enables them to buy a house in Belmont or Palo Alto. So by actually having a liquidity program for the entire employee pool makes sense to me. And someone would say, oh, well, they're not going to put their pants on and show up at work if they're, selling equity, or they'll leave and start another startup. If you go home and tell your spouse, hey baby, I came home with the bacon of $1 million today, and by the way, that means that the rest of our stock is worth $9 million. He or she's going to be like, hey baby, I think you should continue going to work there, because that means we have like $9 million in there. And don't listen to that headhunter or your friend with a stupid idea of a stupid startup. So liquidity is important on all these different levels, and it's very coastal. Even my business partner in New York, he's like, I don't like anybody getting paid. I'm like, I love seeing money flow in all directions. Good.
Early phase startup question.
Awesome.
So if I send a pitch by email to a VC and I don't get a response, give up and move on, or keep trying?
Stalk him until you get a restraining order. No, just kidding. No. I think that if you imagine inbound emails the VC is getting, it's probably worth taking the time and care in our world of social networking to figure out how you're connected. I met someone tonight who said, oh, I noticed that we're both connected to Monty, who just got like he does like CFO work for a bunch of companies. And I thought that was interesting that the person had already gone on LinkedIn and figured out how we're connected. Getting a warm intro is the smartest thing. If I bring a deal to Sony Ventures they're probably going to look at it because they know how many deals I see, and if I'm actually putting my reputation behind this one, then that separates them from the many. In some cases, a warm intro, you have to respond to it or look at it, just to make the person who made the warm intro happy. Out of politeness. I make sure that someone from our firm responds to every email that we get. On the flip side, I don't respond to anything on LinkedIn. On LinkedIn, I'll accept anyone as long as they don't look like they're Nigerian asking me for my birthday, and I think of that as Twitter for me. And I say on my LinkedIn profile, I never respond to messages on LinkedIn, especially those seeking funding. Contact Mike at Rubicon.vc, who's a guy I pay to look at this stuff. And so I think that you want to get a warm intro. The best way, in my opinion, the craftiest, smartest way to approach a VC is look at their portfolio, look at their existing portfolio, find one that you think gives a shit about what you're doing, and then approach that person and say, hey man, this is what I'm working on. Can I meet you for a cup of coffee? Or some ideas for your business, blah, 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 blah. Give them a reason to meet you. And then say, oh, by the way, could you introduce me to, those blood-sucking bastards at Rubicon? And then the other thing is you can also say, are they good or are they bad? And he could be like, oh, out of all my investors, I hate those guys. So you might save yourself a lot of time and be told by the CEO that there's good guys and there's bad guys and them the bad guys. Or the opposite. They'll be like, I love them. We have a couple CEOs that bring us a lot of deal flow. Ultimately, I'd like to see 40% of the deals that we actually invest in coming from existing portfolio founders. I think it's probably the best. And you make your good reputation with your own CEOs, and then the good deals come in there. Sending the email directly is probably a futile exercise, and you might even get logged in their deal flow system as a rejected deal, and making it harder to get in when you get like Zohar to introduce you.
Andrew, thank you very much. I love the model that you have, first of all, and I want to share my experience with you with Qualcomm Ventures.
Were you at Qualcomm?
No. I approached Qualcomm. I'm a founder and a CEO of a startup. I approached Qualcomm in Palo Alto.
Try to speak in the mic, because I'm having trouble.
Can you hear me now?
Yeah.
Okay, great.
Cool.
So I was at Qualcomm Ventures in Palo Alto, and I was there to raise money for my startup. All the decisions come from Japan, and even if he's a managing director of Qualcomm Ventures here in Palo Alto.
You mean Japan or San Diego?
No, right here in.
Okay.
The decisions come from Japan for investments. The problem that I faced was permission for investing from Japan to invest in U.S. Valley. At the end of the meeting, I realized that everything that you have and get a permission from Japan, it's too much of a barrier, or it's not a smooth process. I offered him $3 million at the end of the deal, that in spite of me funding, I'll pay you money, but I want to partner with company. Are you ready for a deal? And would you go and talk to your management in Qualcomm, get back to it? What you're bringing on the table is a bridge between the CEOs and the CW or corporate funding, which will help the young CEOs like us that really are looking for funding to and get their product out in the market.
So I don't quite hear a question, but I would say that I agree. When I was saying if I had gotten my numbers correct, which I number one, and the other number one, is that I think it's good for a VC fund to have some corporate LP limited partner investors in their fund, and have a relationship where we are able to, have someone that we know knows the inside labyrinth to unlock some synergies to add value. Like, if your product could be sold in an IKEA store, and we have IKEA as an investor, then that's better than you dealing with Swedish culture of trying to decide to make one investment into a startup, and then being nervous about the pricing and all kinds of things. But, I don't know. I guess it's pretty public how you just took down Qualcomm Ventures.
My question was very specific. Was when big companies like Qualcomm or any venture capital arm,
Yeah.
they are not as speedy in their decision making process as a actual VC firm is doing it in this market. And why I say that is because um, they are not. The decisions are coming from the corporates exactly, not from the VC firm of their arm. That's the challenge. That's the challenge number one. And I was experienced with that myself.
So I'm sorry. Where's the question?
That I think you're building up a business model where you're trying to bridge the arm between a corporate and a VC arm.
Correct. To some
directly
extent. To
which-
some extent.
Which is really powerful, I think. Which is powerful. That's the
Thank
point
you.
that I'm trying to make.
Okay. Thanks. I agree.
And I just want to try to lay out my example because that's the hardship that I was facing
Yeah.
when I went to Qualcomm, basically.
Yeah, I tried to illustrate that with you may need to make the enterprise sale of get some head of a business division to support you, before you do. Yes.
Hi, Andrew. My name is Han. I'm a new angel investor. So, two related questions. To what extent do you, as VC, partner with angel investor as part of your deal flow to get good quality deal flow? And what is your advice to new angel investor for us to connect with VC for Series A or B?
Yeah. Okay. Let's talk afterwards. So, I co-founded Rubicon as almost like an angel group. Actually, I mean, here's the truth. Joshua Siegel was like my lifelong best friend. New York told me, he's like, hey bro, I sold all my real estate assets, and he had a lot of stuff. And I'm going full-time angel investor here in New York City. I want to be the king of New York, prolific angel investor in New York. And I was like, well, first thing you should do is team up with some other angels. Don't go out hunting on your own in the wild. So if you are out networking to 3 networking events a night, I'm talking to Josh Siegel, and you're doing that every night, and you got out of all the 60 deals you'll see a week, you want to invest in 2 if you had more money. So you're seeing 100 a year that are really good deals, and you're maybe doing 5 deals a year for a professional active guy like Josh. Now imagine you team up with 25 other angels that are all based in New York. You're gonna and you're each pulling in your 2, into the group. Your funnel goes from 100 good ones to 1,000. And in fact, you've got multiple vantage points on the same deal. And you've got different expertise that actually knew the guy before, know his friends. You could pick up the phone and do some checking out without even asking for references. And all of a sudden it becomes much more powerful. So to kind of compartmentalize it, there's teamwork on deal flow is better than running solo. No doubt about it. We even talked about the deal flow problem for a CVC. Then there's teamwork on vetting and evaluating of deals. Major league. So it's one thing to have deal flow. How do you even process it, right? And then the third one is value add post-investment. Bringing a bunch of angels that have different contact networks and expertise and feelings and advice and chemistries to get in there and help value is better. So the biggest advice for you is of some kind, maybe even more than one, and do that, and even learn from operating with the other guys. Try not to learn by wasting your money, So that's a little bit of a perspective on angels. Josh then said, well, why don't we do this? Why don't we do it together? And I actually, just like I gave this presentation of what's, the challenges of CVCs, I could give another presentation of how horrifically bad angel groups are and all the things that are wrong, And I said, why don't we go and solve all these problems? And one problem of the angel group is that, and it's just like it's irrational and foolish for the CEO to turn down BT and Telefonica and AT&T on some deal because he wants to screw everybody in the bar and he's not willing to just take 3 upstairs. Well, one problem, hopefully not everyone followed that, but what? Oops. Okay, so one problem with the angel group is that national CEO says, if I walk into the angel group and pitch you're all angels, the probability of me walking out with a check is less than if I go into Benchmark and pitch on Sand Hill Road. It's actually not true. If you go and pitch benchmark, probability you're going to walk out with money. Whereas if you pitch a whole group of angels, there's a higher probability of actually getting money. But it doesn't matter. That's what they think. Functional reality is they don't want to pitch angel groups. And then you got these like, oh, I'm Joe Lonsdale. I'm beyond pitching a bunch of angels, but I'll go meet Peter Thiel for a coffee. So they actually don't want. There's adverse selection. So you're getting the bad deals when you're at most of those angels. And your deal flow goes better when you have a fund. So I said to all the angels, let's all put a little bit of our money into one pot and let me and Josh actually look at all the deal flow coming from all of you. We'll work with you. We'll leverage the whole universe of all your power for all the vetting. And then we'll pitch the CEOs how I can make it rain and make it happen for you from Japan to China to everywhere, and Europe and right here in New York, because our angels are everywhere. But we can move quickly. So we actually have a checkbook. And let's just call ourselves whatever venture capital. Rubicon works. So we actually are an angel group that turned into a venture fund and then said, look at our massive mafia of angels. Now let's get some corporate money. Let's get some financial money. Let's get some big money in. And so we could, because it's actually tragic for me to take a deal that we seeded and we took on early. We added a lot of value. We spent a lot of time with the CEO and their spouse. And then all of a sudden we give away everything to Benchmark. I want Benchmark to come in, but I want to be at least half the deal. And so I want more money to do it. And that's greed. So, I'm not going to give a greed is good speech. But so I think as an angel, if you can get into a fund like ours, like we should talk. We actually accept money from angels at relatively small check sizes. And I don't want to violate any general solicitation to go into too much more detail. But we think it's important to have a ton of angels involved for all those reasons, but the ability to move fast. And then the angels can double down in the deals they like in the sidecar. So that's the birth of the sidecar for us. VC fund moves quickly, gets into the very best deals. Then we have a sidecar populated by angels, corporates, financial guys, family offices who own a lot of crap that they can leverage like a corporate, like a CVC. And then a second check comes in, and then we explain to the CEO, let me tell you who just invested in your company. A bunch of corporates, those guys just like you, but their company failed, succeeded, and then we populate the company taking board seats from the angels. So now the angels end up on a bunch of board seats, and they can really be 100% angel if they want to. Oh.
I really appreciate how much Silicon Valley has gone from.
Speaking to the mic, and I'll try to repeat the question if.
Yeah, if Silicon Valley has. I can just use it without. Hello. Test.
And by the way, while we're waiting, it's supposed to be Christmas dinner, so people should be drinking as long as you're not driving. So it's not rude. Just go over and get yourself a glass of wine.
Hello. Hello.
Question, please.
Yeah, so Silicon Valley has gone so ahead of its time, even since the 80s, and we've been hearing a lot of talk about this specific type of this. The one thing that I am very curious about is where is Silicon Valley going, and why are there companies like this that invest in companies? What are you guys looking for, or what's your vision? Where are you guys headed to? Why are you guys putting money into companies, or money into companies that generate cash or for the shareholders? But what's that one thing that's driving this cycle of freedom for choice, and or more specifically, why are you guys, or why invest in a company? What are you guys looking for other than making a dollar, other than feeding families? What's the drive? Why are you guys choosing these companies? And
Okay, I'll cut you off and answer one of these. So,
similar one.
I would say that I'm an entrepreneur. It's in my DNA. I believe in flow, and I was talking to a client today in Switzerland who has recognized that he's unhappy in his current job, and he wants to be a professor. And I encourage him to make that move and be a professor because that's what he wants to do. That's where he'll be happiest. And I thought about, oh man, I love this guy. And it's been like 6, 7 years he's been at this one job and he has no passion at all for it. How could he possibly be successful if he's so unpassionate, doing what he's doing? So for me personally, being around entrepreneurship and deals in this exciting level of business, it's what I like. And it takes me to cities and places that I like. I find it's very international. So for me, I think I'm doing what I'm doing. And I think, if you follow you'll probably enjoy your limited time in this world. So, for me, it's a struggle of how much time with my family and how much time, with my business and stuff. I think other questions hearing in there was like, what reasons do you do to make a dollar, or is it all about making a dollar? On the venture capital side, one needs to recognize that if you don't make a financial return relatively fast for your investors, you're not going to be able to raise more money from those investors, and it's going to be a hard pitch getting anyone to invest in your fund when you've been consistently losing money. You might say we're elevating mankind with biotech or clean tech, but when it comes to like the kind of stuff we invest in, which is mostly internet and software, getting points on the board and returning money to the investor, that's pretty damn important. So that is a major objective of mine every day, to make sure that what I'm doing is demonstrating, like right now we've got a 93% IRR, and that's pretty good. So that should attract more investors, and I can keep this disco going, right? And I don't have to get a job doing something I don't want to do. On the other hand, I want to make sure that 40% of my deals are coming from founders. And I think that ultimately deal flow, getting the best deal flow and being able to convince the CEO to let you in are the two things that will actually drive that IRR and success. So you need to be good enough to attract the best deals and live your life a bit honorably, and do what you say you're going to do, and make people say good things about you. There's always going to be people saying bad things about you when you're in the business of saying no, right? And some people are cool about it, and some people are not so mature about that. But the second driver is not just to make a dollar, but to get as many CEOs and founders and even other people in the ecosystem saying good things about you. And then there's relations with being able to sell the company. So I like to think that I'm better than most investment bankers on being able to sell a company because one of our angels has got that relationship. I know the head of corp dev of every major, big company in the Valley that'll buy most of the companies we invest in, but good to relationships in Japan, being close with WIL, and they've got a lot of great corporates or TA Consortium. So I feel like I've got the boss of, I got to make money for my investors. I got to make the CEOs happy. I got to get the corporates willing to, share information and tell me, would you buy this company, or are you building it yourself, and should I invest in it? Sometimes we've already figured out what Google is willing to pay for the company before we invest in it. And now it doesn't Google, but so there's different stakeholders in the ecosystem, and so I think for us it's important to tie those all together. And then there's whatever's happening in the Valley is a little bit of a microcosm for what's happening in Kazakhstan or all over the world. So the world's there's a lot of opportunities outside of the Silicon Valley too. If all you do is offer the Silicon Valley more Silicon Valley, I think that's getting a little boring. It's important to differentiate yourself. But we can talk offline. It sounds like you had other questions.
Can you hear me okay?
Andrew, hi.
Hey, good to see you again.
So,
Sergey, right?
yes, that's right.
Hey.
Very nice of you to remember. So startups raising seed money, looking for angels that bring more to the table than just the money. what I would be interested in hearing is your perspective from standpoint of what you were involved in pitching yourself to the CEOs, including on behalf of other people. So really, how much of those things are real? What should people be looking
What things?
for? The value that
Ah.
the angels carry to the companies that they fund.
So to repeat the question, from my perspective of when I was raising angel funding myself or advising others,
Right.
you're looking for angels that add value beyond just the commodity dollars.
Right. The question is straightforward in its basic form. What do you look for in angel investors other than, their appreciation for the business model and their readiness to invest? You need people who will pull in more than financial capital, and the theoretic answer to that question is clear. What's interesting is your perspective when you were on the other side,
Okay.
pitching yourself startups, and how much of that was real and how much was really less than real.
Okay. I think promises from any investor and put me at the top of that list is overrated. So at the end of the day, I can stand up here and say how the future of venture capital is how I'm going to add value to you. And now I've established my business with angels and corporates and big investors and family offices to add value. It's actually all a lot of hot air bullshit, right? What you really need is the money. And, you pretend to pay people, they pretend to work. If a company is not generating revenue to pay salaries and stuff, or getting money in from investors, the blood will leave the body and it'll die. So what you really need is the capital, right? So, people will say a lot of stuff in a bar to get you upstairs. So I think that at the end of the day, that capital, that commodity, is very important. And but you want to plan for. You don't want to sell too much of your equity when the price is low, early days. And so you want to kind of build up your equity and sell 10 or 20 or 15% with each round, somewhere in there, and sell at higher valuations to continue to capitalize and grow the business. So getting investors in that can add value should be your objective. And even higher on your objective is not take money from someone that's so toxic that no one else will want to work with you. There are VCs, like one in LA, that if I see that VC in there, I will not go near the deal. So that's one thing. To get personal, when I was raising money for the GTX, I had bumped into Dieter Leister, the then CEO of Deutsche Telekom before Ron Summers, and I said, "Hey, I've pitched almost no one in my business, but let me tell you what I'm working on." And he said, "I will step on you like bug and destroy you." I was like, "I guess it's pretty disruptive. He wants to kill me. I better lawyer up." And so, so before talking to any angels, I was in D.C., which is a very telecom place where deregulation happened. MCI was there, all the engineers. And I made the rounds and met with all the lawyers I could get introduced to. So I was asking professors, my dad, anybody I knew, who knows securities work or deregulation telecom stuff, even intellectual property type stuff. I'll basically want to pitch any lawyer. I pitched something like, back then you had to get like the translucent slides at Kinko's, which were very expensive for me. And then you want to make one change. Oh, Richard Branson's in my deal. It's like, oh, fuck, forget Richard Branson. We're just sticking with those slides. They cost 10 cents each. So I was pitching lawyers. So I pitched a bunch of lawyers first. If you can meet with Andre, this guy knows a lot of people here, Silicon Valley Innovation Center. I was pitching anybody I could and avoiding the angels and avoiding the VCs. And I basically got a bunch of people excited about my business. I pitched Oracle, even like the Oracle Salesforce, because I thought, back then there was no Amazon. You needed this crap, buying Sun Sparks for $50K each. And so I pitched a lot of people. It's a bit like saying, before we try and go meet some girls in the bar, let's make some friends with guys. Like, we're in the north of England. Otherwise, we're going to. So, I went and got a bunch of kind of support people for my business before going out to any investors. And then, when it came to investors, it was all warm intros. There was no emailing anything. I did send a fax to Frank Quattrone saying, "If you want to make $1 billion." No, but like and that fax didn't work. I've never met Frank Quattrone. So that was for me personally. On that, my first angel randomly came from Madrid. It was through a family connection. Yeah, the other thing I'll say is that, start with somebody that knows you and loves you and likes you, and then go to somebody that you think is a layup, and then start getting credible names in your thing. If you see, if an investor sees a very exciting, disruptive startup idea with nobody around it and you don't know the guy, it's less exciting than saying, whoa, CEO of Salesforce likes this so much that he personally is invested, and the former CTO of Oracle is involved in this deal. There must be something there. Let's get this guy in. Let's meet this guy. Let's talk offline.
Hi. Can you hear me? Just over here. Sorry. Stand up. Hi, I'm from Australia. This question may have already been answered, but what are some of the keys that I'm wanting to do a startup, what are some of the key areas I should focus on to start with, and what makes a startup attractive for VCs?
Yeah. Okay. Great question. I think that the at the very, 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 very early conception stage, the best thing to do is get a co-founder. Be alone trying to take on such a big task is a problem. And so getting a co-founder is key. So I think that's kind of like a number one thing. A second thing is what's a big market to disrupt? If the total size of the business is not going to get that big, then it doesn't even justify the fee structure, the venture returns, that VCs take. And then I'll tie it back to Sergey. Sergey, I had one other thing I wanted to say in response to your earlier question, which I'll tie into this, is when choosing those angels, every different, right? I mean, they're all different, they're all unique. And if you remember the old TV show, not the Tom Cruise, but the old TV show Mission Impossible, where like Mr. Phelps gets like, the exploding, self-destructing message, we're going to take out some dictator or change the government in Nicaragua. He would start off sitting with his legs up in his 1950s house and look through the headshots of the people, right? Remember that? He's like, here's my black dude, safecracker. Here's my woman who can speak with a Berlinish accent or whatever. You basically say, who are the key people I need to pull off mission, right? And so you might think on your own business and like whiteboard it or think it through. Who do I need? And this is for you from Australia. Who do I need access to give me unfair advantage to make this thing work? What industry am I in? So if I got a guy who knows about Chuck E. Cheese, would that guy be able to make it rain for me and make it happen? Or forget that because who do I need to bring that'll really make it happen? I need someone that can crack a safe. I need someone who's an explosive expert. I need someone who can speak German, sound like they're from Berlin. Like whatever it is for your Mission Impossible. And then figure out how to network a path to them. A lot of these people, unless they're really retired, are on LinkedIn. So, and then, develop your networks. You got your family network, you got your army network, you got your whatever network, and press them all. And then go to a lot of painful networking events like this. Hopefully they don't run out of booze. Wait, I'll say one other thing. Come up with an idea that makes money. Like my first business, we were brokering bandwidth trades. So all of a sudden deregulation happened and Global Crossing had a and I was selling the fiber optic cables and the pipes that it went into before, and I realized that the way I would say before, like a good salesman, I'd say, do you have the money to how do I know you've got enough money to buy? I'm trying to pre-sell the cable now. And so they were getting people to sign agreements that if that cable exists, I'm in for $20 million. And so I made an equity exchange. I made a telecom exchange on the internet for people to buy and sell and trade telecom capacity on the spot market and on the future market. And what was cool about it was that I made the website. I'm not super technical, but HTML. And then I, on credit cards, went to some trade shows and, got everybody to put their capacity on there, including FT and France Telecom and these guys. And Next thing you know, I brokered like a $16 million trade and got paid 8%, you know? And so I generated some revenue. So I became like Christie's and Sotheby's for telecom. Generating so much money, we were so young and crazy, we were like, oh, these VCs are out to get us. You know, so the VCs wanted us because we were generating revenue like crazy. So that's a good thing. Come up with money. Sounds really, really dumb. But if there's more entrepreneurs than there are investors, that'll get you noticed. Sorry, I cut off the next question. Where was that coming from?
Yeah, just quick question. What's the minimum investment your fund require?
As of now, it's $100,000. So this is meant to enable us to grow the network. And typically, when someone puts $100,000 in the fund, they bought a ticket to basically the investing club. Now they have access to Series A, B, and C, which they've never had before, and they have access to a ton of early stage. So like the way our fund is structured is that we make 10 investments a year into startups that have not yet raised that Series A thing. Just like the IPO got further away, the Series A is now supersized. I mean, we could talk on another time about how VCs got too big. But so we do, over 5 years, that's 50 deals. So kind of like, you know, an angel is going to have access to all 50 of those deals to co-invest. Not always, but if they want to pre-bake that they'll co-invest, they can know they can get into every deal through the sidecar fund. So they can choose which one in on that, or they can say, forget that. I just want to invest in the Series A's, B's, and C's that have never been available to me. I'm doing a good job myself in getting into seed. So we're unique in enabling them, like we're their only way to get into A, B, and C, which were otherwise closed. One thing that's very innovative that I think it'll be copied because it just makes us so much money is that if we put $1 million into a company from the fund and then we get a sidecar worth 1 million or even 5 million and we wire that money to the startup, the sidecar has got deal by deal carry. $1 million sidecar. We aggregated some corporates and some angels and some financial guys that we pay the first $1 million back so they get all their money back, and then we get 20% of the carry on that deal without being weighted down by any of the other investments or weighting. That's super. That's like breaking the laws of physics. And yet we were giving the investors what they want, give the people what they want, let them do deal by deal investing, which is awesome. And then we populate the company, people who give a shit about the company, who can actually unlock value because that family office owns something and can make it rain for that company. Here's the crazy thing we do. Greedy. And keep all the 20% for me and Josh and Mike. You know, the guys that work at our fund. That's the profit. You know, the 20% of the profit. We actually pay a chunk of that as a distribution to everyone in the fund. So if you're in the fund, whatever your IRR return is, and cash on cash multiple, you just get paid more money from the money that other people's money being put at risk into those deals. And that's really, really smart. Does that make sense? I can't say that publicly. I think that starts to sound like SEC general solicitation, but I could talk to you offline. I'm told I can say this, 93% IRR as of now.
Hi, my name is Michael, early stage seed round, and your book has been incredible. Learned a lot from you, and your advice here is phenomenal. Back to kind of the bigger VCs again.
By the way, when I hear that, I feel like, are we like at some like self-help thing?
No, I was just going to say.
Everyone stand up and say I felt it.
I was actually going to say,
It's
here's
like,
a free plug for the book.
So, okay. Thank you.
Anyways, back to the big VCs. So nowadays I'm hearing that there's micro rounds and micro groups, like where you're having the offshoots with the angels getting embedded.
Micro VCs?
Micro VC
Right,
funds, right? Trying to get in more. Why do you see why do you see a shift in that direction these days?
Sure. Okay, so and I don't feel that old, although I've been around to see you know, what happened from the mid 90s, you know, 93 when the internet came out to where we are today. My theory is that in 2001, the tech industry got kicked in the nuts really, really hard, right? And, you know, it was like everyone was piling on, and then it came crashing down. And then in 2008, oh my God, we got kicked in the nuts again. It came crashing down. And in both of these instances, the big investors somehow said, look, venture might have taken a beating, and the stock market might have taken a beating, but you should see real estate. That took a massive beating, especially in the 2008, you know, kick in the nuts. And so they somehow decided it was safer to put money into venture capital than even before. So they re-upped and doubled up and 5-timed up their commitments to the big VC funds, and they unplugged their commitments to the small, crappy vintage 2000 LA funds that just lost literally all the money. It's almost impossible to lose all the money. You've invested in 20 companies or 50 companies, you actually lost it all. They did. So what ended up happening is that the dynasty funds that are on like Fund 9, they got bigger, and they bought bigger kitchens. And I say that meaning, like, why didn't they do something like Google Ventures of invest in their own business? Like Andreessen Horowitz is like the only fund that's actually set themselves up in like a company to help you, like their Google Ventures. So the VC. So what happened? Here's what happened: the $50 million fund became a $250 million fund, or it died. Everything from 50 million to 550 almost disappeared. So the normal-looking VC funds just poofed. They don't poof away. They just become zombies. They fail to raise the next fund, and we call it zombies. That's not just me saying that. And they fail to raise a new fund, and they're no longer actively making new investments. They're just going to board seats or observing. And then the surviving funds became mega funds. Okay, so if you have a mega fund, and I won't say anyone's name, but let's just say $750 million is the size of the new fund, or $1.2 billion is the size of the new fund. And if they invest in your startup, statistically, it's likely that if your company is successful, it'll be an M&A exit, and it'll be somewhere between $30 and $150 million. If they own a third of your company at the time of exit, and they have a board seat taken model where every VC is doing everything themselves, so they don't have the angels taking the board seats, they do it. If your company sells for less than like a big number, it's becoming statistically unlikely that all the money and get into carry. So if an offer comes for you to sell your company to Google or Facebook for like 150 million, they're going to invoke potentially blocking rights on the sale. So although they're minority guys, they might have blocking rights on a sale. And they're going to hire a CEO and fire you and get a CEO who's willing to take a $25 million check. The $150 million, price point of a buyer was a good data point that they should put another 50 million in out of their $1 billion fund and fight on or a bigger exit. Remember the guys that bought out Zohar for $5 million to push for to align interests. So in a world of cheaper to start company, we're getting down to that 2-year exit horizon again. It's really happening, as opposed to that 7-9 year thing. The large fund is challenged to operate in this new world of, Oracle and Sun in the 90s. You just use Amazon or Azure or something, right? So it's cheaper and faster to get going. The companies are often going to be sold for less. If your strategy is underpinned by hunting unicorn, it's statistically improbable that you're going to get into carry. So we're now in a world of these big mega-sized funds. And at the same time, you've got like, Mike Maples and a whole bunch of guys came out and raised new funds that were small. They raised the funds that they could raise, and then they filled in the gap. And you got like your Ron Conway with SV Angel doing 2 to 4 investments a week, whether he needs a shower or not. Just like, investing in a ton of companies and not really following on. And so then people noticed that like, well, he's been around since '94 doing this, and he was here before then, but like he's in Zynga, Facebook, Google, Twitter. A lot of people said Groupon, I'll do it for Boston or something like that. So there's a whole bunch of new that came out as the sub $50 million micro VC, and there's different definitions of micro VC. But so we kind of lost the middle. We got this new mega thing that's like definitely barbell, if not private equity. And they're venture guys. So they're pushing guys to go for these big risks. They're not just buying roll-ups of dry cleaners. And then down here, you've got all these new funds that are doing pretty good. And now we're now moving back to normalcy. They're saying like, hey, I did pretty well. I got my 93% IRR. How about giving me a $250 million fund or a $150 million fund? So we're starting to fill that missing bit in again. Mm-hmm. So it's a little circular, in that. But the truth is there's never been so many young people who had just sold their company that have the appetite to invest in your startup. So there's a whole new population of people to invest in that are different from, like, it used to be the former CTO of Symantec or something who's old. You're now literally dealing with like a 22-year-old being like, all right, I said I'm in. Stop pitching me. Jesus, what are we doing here? We're standing outside of a bar for like 18 minutes. You had me at hello. So there's this young population that are investing. There's AngelList. Use it. Duh. There's, depending on your business, there's, equity and, pre-sales, rewards-based crowdfunding. And then there's all these micro VCs trying to copy Conway, saying I'll do 2 deals a week whether or not I need a shower. There's a lot of new stuff in that early stage. Did I miss a question in there?
No. Okay, so here comes the party pooper. Whoever has the microphone now has the last. And after that, we'll have plenty of time for networking, asking questions privately. I mean, if you want to stay here till midnight, we'll be in trouble with the landlord, but we'll figure something out.
And I'll stick around.
Hi, my name's Robert. I've had a company that's been in business for 7 years now, so I feel like I'm a little bit of an anomaly. Software platform, it was bootstrapped, with little outside investment from a friend. And at this point, I'm very curious because we have a company that's been relatively successful. It's been kind of a lifestyle company, as I would call it.
Right.
Definitely thinking, though, either push it forward or do something else, basically. My question is, when you're looking at these deals, if the deal flow is your lifeblood, are you looking at the idea mostly? Are you looking at the team that you're investing in? What is it that you really value in that? Because I'm definitely concerned. We've tried to be lean and mean. We've got a team of 5 that runs the whole show. Is that enough of a team when you're looking at a company, or what are you looking for?
I'll talk to you personally offline on your company, rather than this public forum for that. The shortest answer I can give on what we look for is it's a balanced scorecard of things that we consider, and the biggest elements in that decision-making equation are the team. I've sometimes earlier in life into an idea that I thought was killer and a technology that I thought was brilliant, but I knew the CEO was a raging asshole and an axe murderer. And in the end of the day, you just gotta there's a lot of temptation in life that you don't want to get into, and that's one, right? So I look for team as the most important thing, and the CEO can seduce me and make me fall in love. And the second thing is that there needs to be a big market they're going for. Depending on how early you're going in at, and this is all assuming we're talking early. If it's early, it's likely that the company is going to pivot and things will change. Even if everything we've got is on track, something beyond our control is going to change. Look at the Russian ruble. It's beyond my control. So in a world of pivots, you're left with the management team you're backing and the market that they were hopefully born to, disrupt. So I would say those are the, I could go on and on and on, but those are the 2 big things. If it happens to check other boxes, like it's got technology that we deem to be miracle, then we think there's some real substance there. If there's revenue traction and customer traction and distribution traction, or the guy brings his old distribution network to this new deal, and this is his 3rd deal in the same kind of thing, so that all those old relationships are relevant, they're mostly still there. If the company got shut down by regulators, but they still have like 60,000 users, maybe 20,000 of that is real, like when Skype launched, I talk about it in the book, they had Kazaa, they had the button, Nicholas and Giannis had made Kazaa, like a copycat of Napster in Sweden. And they had 11,000 uniques coming there. And so when they launched Skype, it was a soft phone client. I knew 1 million people that had that. I'm a telecom guy. For $5,000, I could be competing with that a month. And they had this button on Kazaa that was like the perfect set of people that don't pay for their software, their music, their other stuff they're getting there. And that's perfect people to not pay for their telecom. Comfortable with peer-to-peer, all-you-can-eat bandwidth, things which back then was big. So I look at, a balanced scorecard of things, for sure. But not comfortable with the team and the market, then I'm quick to pass. If you're looking at 10,000 deals, you want to be quick to pass, and not string along someone either. So I guess with that, I'm happy to talk. Let's have all of you network, and hopefully you guys can help each other and enjoy some wine and food.
Thank you, Andrew. Thank you very much for a wonderful evening. It was a great closing for our 2014 session.
Yeah.
And we look forward to seeing you with us in the next year.
Yeah, and I'd like to thank you, Arthur, and Andre. Thank you so much. You're still standing from your trip back. Thank you. Thanks for having me. Cheers.